So Gershon, let me ask you as the fixed income guy, do you look across the Atlantic Ocean with some envy because we're getting left behind in the United States when it comes to green bonds?
Well, not really. I mean, certainly the growth has been more in Europe and the UK, but I think some of the more interesting innovation has been in the United States. We at AB are very, very big on incentives. And, what we see in Europe, despite the growth of it, is not a lot of teeth in companies failing to meet their objectives. And we're seeing a lot of interesting things in the United States. I'll give you a couple quick examples. Most recently, there was a municipal issue from the Sewer Authority of New York. I think it was in the Buffalo area, that tied their use of proceeds to building out green infrastructure. And the interesting thing, though, is there's specific metrics, and if they hit those metrics, then they're actually able to call the bond at a more favorable price. If not, the price is going to be a lot higher. Second example, a U.S. energy company, NextEra, they came up with a very innovative structure where the green bond proceeds are earmarked to build out renewable energy capacity. And if they don't hit the agreed upon targets with the bond investors, the coupon actually steps up 25 basis points. There's a real financial penalty to not meeting the goals. We think we need to see a lot more of that if we're going to really have an impact the way we all want it to.
Well, I sure want to come back to that, Gershon, but first I want to go to the equity side and talk to Barbara Ann about this. Is there anything the equity side can learn from the fixed income side? You and I have talked on Wall Street Week before about equity investment in sustainable things.
I think there's lots the equity market can learn, but Gershon, I totally agree with you. Climate transition covenants are key because it's a systemic risk if you're loaning money for 20 years and they're not taking in climate, right? You're mispricing risk. So I totally agree. I'm excited about that. In the equity markets, it's amazing. The correlation between ESG ratings is 0.3 for the same companies. So that means an ESG rater can think Google has a positive ESG score, and another one can think it is a negative one. There is no consensus around materiality. And that's the case for Google and Caterpillar and lots of big companies. Whereas what I like about the bond market, you have Moody's and you have S&P, and there's consensus around materiality. You don't find a company that is junk rated by one and AAA rated by another, right? The correlation between their ratings is 0.99. And that is driving the behavior and capital that Gershon is talking about. So the opportunity for the equity markets is to gain consensus around materiality. And you can have differences of opinion, but within a framework. And so the companies that I think are really using green bonds in an effective way are companies like Toyota. They have a goal of reducing CO2 from their fleet sales by 90% by 2050. Well, the only way for them to do that is to sell more EV cars. So they just issued a green bond, and the proceeds are being used to finance the purchase of their EV vehicles. It's genius, right? So yeah, I think Toyota's doing a great job. I think all car companies should issue green bonds to finance the purchase of, it's a lower cost of capital for the customer, and it's a way to move the needle.
I'm sorry.
The difference is like green bonds are, what matters is the company's rating, right? Their credit rating, and then the project is independently assessed. Right. So an Exxon, for example, could issue a green bond and lower their weighted average cost of capital, so long as that money was being used for a green project. So the debt and equity markets are taking very different approaches here.
But Gershon, I want to come back to your question because I want to understand this. I'm not sure I do understand it. It's one thing to say I'm going to borrow a lot of money for a green project. It might be a good green project. It's another thing to say if I don't actually meet my goals, I'm going to have a real penalty. Bloomberg did a survey recently of a lot of the green bonds, and a surprising number of them had very, very small penalties if you didn't make your numbers on the green part of it. Are you saying it's fundamentally different between Europe and the United States in that regard?
I don't know. I wouldn't say it's fundamentally different. I think it's weak all around. I'm just saying some of the more innovative structures have come out of the United States. I think what it all comes down to, David, is investor education. And we at AB are very proud that we partnered with Columbia's Earth Institute to develop a curriculum on this to educate investors. We were the founding members. I sat through climate school. You have to remember, I've been looking at economies and companies for over 2 decades, I never gave climate a second thought. You have to understand what are the potential impacts? Who could the winners and losers be? What are the right questions to ask when you're engaging with company management? We're actually taking our partnership with Columbia even further now and doing some really innovative research that's going to help us model these things. Until investors get educated, it's easy to just say, I care about climate, I care about other socially responsible things. That's easy, and everyone's saying that. The real question is, are you educating your investors in a way that they're actually going to demand of these companies and governments and other entities that they actually adhere, they actually move the ball forward? Because again, it's incentives. If investors aren't really demanding it, and not just, as you pointed out, David, we call it greenwashing, right? Just saying we're going to do these great things. If you don't put hard metrics, you do X or else the consequence is Y. If you don't get to that point, we're not going to make the kind of impact we all want to.
So Barbara, and beyond the question of greenwashing, which I think is a substantial issue, we're all agreeing, are there enough useful projects actually to put all this money to work? If you talk to all the banks and their funds are putting, it's literally trillions of dollars. Can we put that kind of money to work to make a difference in the environment?
And that's the importance of verifying the projects. And that's another difference. In the bond markets, the projects are independently verified and there's reporting associated with that loan. And so you're absolutely right, David. It's the quality of the project that determines whether or not it's greenwashing.
So Gershon, what are you doing in the area of bond funds that are green? Because we certainly hear from Bank of America, from so many banks, they've got huge funds now they're putting together.
Yeah, we definitely have a muni impact fund that we've had a lot of success with. We have a corporate responsibility fund. But the real key is to get these green bonds and these KPI-linked bonds, et cetera, into more mainstream portfolios. We have to grow the market for them. If we get every fund that's not quote unquote an ESG or an RI fund interested in these opportunities, then there's going to be a lot more investor clout to demand better results.
Barbara, and let me ask the question nobody wants to think about. Do we need the government to step in and have some regulation, yes, on the disclosures to make sure we know what the rules are? We do that certainly with GAAP, right, with accounting principles.
Well, I think the SEC is trying, right? They said they're going to crack down on this. And the first company they went after was surprisingly DWS, and that share price was down double digit the day they said they were going to examine what exactly they mean by ESG. And so I think that's absolutely coming down the pipeline. And at my firm, we welcome it. I mean, we're very authentic about our ESG. And I think there's a ton of greenwashing out there in the equity markets by way of companies hugging the index, just slightly overweighting tech, underweighting energy, and charging a premium for it. That is nonsense. And that is not profiting from nor participating in the energy transition, and it certainly won't accelerate it. So what's important is to get more money to the companies that are actually decarbonizing and changing the world.
Gershon, same question to you. Can the private sector take care of it on itself, maybe through alliances and maybe even international to really measure these things, or do we need government intervention?
Look, I'm more of a free markets person personally, so I believe markets can't solve everything, but regulation always has. For every piece of regulation that you think is doing something positive, there's a negative impact, and it's really hard to move all the variables around. So I don't believe that government is necessarily the solution here. I think that, again, if we empower market participants, the overwhelming majority of which care very much about these issues, if we empower them to ask the right questions of companies, we will demand as an industry accountability from corporate America, and we'll look back 10 or 20 years from now and see how much we've accomplished.
Barbara, just in the last few seconds, are you optimistic, because you know this area terribly well?
Yeah, I am optimistic. I think the more we call it this greenwashing and the more authentic products that are given to the market, that we can accelerate this. There is enough money to solve this 3 times over. The problem is it's going to all the wrong companies.